at our last meeting, and this was in the minutes from the meeting, many on the committee thought it would be appropriate for there to be one or more 50 basis point hikes.
Are you one of those people?
I don't disclose my own path. I try to lead the committee, but.
Oh my God. Oh, you're killing me.
So I think markets are processing what we're saying. They're reacting appropriately generally, but I wouldn't want to bless any particular market pricing. The thing I want to say, though, is we really are committed to using our tools to get 2% inflation back. And I think if you look at, for example, if you look at the last tightening cycle, which was a 2-year string of 25 basis point hikes from 2004 to 2006, inflation was a little over 3%. So inflation is much higher now, and our policy rate is still more accommodative than it was then. So
I'm Captain Obvious.
It is appropriate, in my view, to be moving a little more quickly. And I also think there's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So that does point, that points in the direction of 50 basis points being on the table. Certainly, we make these decisions at the meeting, and we'll make them meeting by meeting, but I would say that 50 basis points will be on the table for the May meeting.
Now, can't you give me a straight answer anymore?
All right. Today is Thursday, April 21st, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. Everything started hunky-dory in the morning, led by the Tesla optimism. Tesla was moving higher, and so was the stock market, a gap higher. Everything is good. We're high. We're off the 420 high. And then came the dip buyer slayer. Papa Jerome Powell came out slashing the dip buyers left and right, left and right. What did Jerome Powell say, by the way? We'll talk about that when we get to the program. But remember what we said in this program a few months ago. Matter of fact, 4 months ago, if not more. We said, remember not to fight the Fed. When the market was going higher, the bulls kept saying, don't fight the Fed. The bears, you're too pessimistic. You're perma-bear, yada, yada, yada. Don't fight the Fed. Okay, so now when the Fed is tightening, how come the same rule doesn't apply anymore? And today was an illustration of the don't fight the Fed rule. Every time we buy the dip, every time we move the equities market higher, specifically the most garbage stocks higher, here comes Jerome Powell reminding us that he's not done with the job yet. Matter of fact, he did not even start yet. The Fed is way behind the curve, and it needs to tackle this inflation aggressively, which will cause destruction all over the place. We're already seeing the destruction beforehand. Take, for example, the Netflix disaster. We're already seeing the casualties appearing. Number one, Snake Bill Ackman. Well, he's down $400 million. He bailed out, waving the white flag. No more. Please, no more. And it's not just Bill Ackman, by the way. We talk about the streaming war and the casualties. Down goes CNN Plus. Rest in peace. Poof. Gone. Even before the streaming even started. Dead on arrival. It is becoming highly competitive and highly dangerous in this economy right now. Things are changing rapidly. We're seeing massive bags across the board. Not just Bill Ackman or CNN Plus. Even the Wealth Fund of Norway is down $74 billion. In the first quarter of this year alone. Now, it's a different situation entirely when you and I or Bill Ackman hold the bag, but when an entire company holds the bag, oh boy. But rest assured, you got your favorite analyst, Jim Cramer, who says, seasoned technical analysts expect inflation peak. Market rally into June. Bye, 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 bye. And of course, we know how that's going so far. A complete disaster. And today was a bloodbath across the board. No mercy at all. It's not just the tech stocks, the high multiple stocks. It is banks. It is energy. It is materials. It is fertilizers. It is consumer staples. It's everything down. And if the market was heading down before today, we would have said, okay, this looks like a bottom. But this happened on the heels of a disaster out of Netflix, a growth kind of scare, and most importantly, amidst a rebound. But luckily for the viewers of this channel, I've been taking care of you. Remember, about a month or so, I told you, when the VIX is below 20, you gotta buy those puts with both hands. Look at your portfolio. Which stocks ran the highest? Which stocks are gonna get hit, possibly, by the earnings season? And start hedging when these premiums are cheap. Take a listen. VIX 4 hours chart. Look at this meltdown. A historic meltdown in the VIX, the likes that we have never seen since 2009, by the way. And now the VIX is getting way oversold. Why do I smell a trap here? Why do I smell that this is not right? That this is complacency? That this is not legit? Not a green signal for risk on, even though the VIX is below 20. Perhaps because we have other volatility gauges, for example, the Bank of America MOVE index, actually moving higher. Or take, for example, the JP Morgan Global FX Volatility Index, which is also moving higher. But somehow the VIX is going down. Doesn't make sense, does it? And now the VIX is trading at a discount. The realized volatility, the S&P 500. Most of the times, when this happens, we see a sharp snapback in the VIX, specifically when you put two and two together, and you realize that we have an earnings season coming up. This crash in the VIX is giving me the opportunity to load up in puts, specifically on stocks that I own, the insurance policy, because some of them are going down, by the way, specifically the commodities stocks like Nutrien, like Mosaic. So I'm taking advantage of cheap put options, cheap premiums, because the VIX is down, to accumulate these puts ahead of earnings. But if this is right, we will see a snapback in the VIX, perhaps when the pumpers run out of time by the end of the month. We'll see. Folks, we're going to talk about this and a lot more in tonight's program. And here it is, in focus tonight. The party is over. The hawk is coming down with the hammer, with his tools. Remember the toolbox? And he's going to use this hammer to smack your little head. So watch out. When we talk about the wall of worry, let's talk about the Fed in tonight's episode, because things are developing rapidly. Inflation is sky high. This is not a surprise to anyone. We got readings yesterday from Canada, for example. Inflation at 31-year high. When we talk about U.S. inflation, we got the Fed's Beige Book this week. What do they say about the economy? This is the Fed, by the way. This is the propaganda. The U.S. economy expanded at a moderate pace from March through April 11. Uh-oh, moderate, you say? What happened to the hot economy? Anyways, consumer spending picked up and more workers went back to the office. Farmers also benefited from surging crop prices, though the result is that households will end up paying more for groceries or eating out. Businesses were a bit less confident about what lies ahead, though. Outlooks for future growth were clouded by the uncertainty created by recent geopolitical developments, rising prices. When it comes to inflation, the Beige Book says inflationary pressures remain strong since the last report, with firms continuing to pass swiftly rising input costs through to consumers or customers. You and I. Put another way, inflation is still far too high and unlikely to ease much in the next few months. Again, this is the Fed talking, folks. When it comes to jobs, the Beige Book says demand for labor is strong, the Fed said, but a shortage of workers is still the biggest obstacle of hiring. Even higher wages have not been enough to draw more people back into the labor market. Job hopping is also a big problem. Many firms reported significant turnover as workers left for higher wages. This is important. Wages continue to move higher. Wage inflation, the stickiest part of inflation, is still here and it's not peaking at all. Persistent labor demand continued to fuel strong wage growth, the Fed said, particularly for footloose workers willing to change jobs. Here it is, the R word, recession. The Fed says there were hardly any talk about the threat of a U.S. recession. Oh, really? Only one business person surveyed mentioned the possibility. A few companies raised the prospect of a recession in Europe stemming from the war in Ukraine. Fed officials have insisted that they can slow inflation without slowing the economy, but it is seldom achieved the goal when inflation has been as high as it is right now. And here is the reality, folks. When we look at different economies, global economies, GDP growth is lacking the CPI growth. The rise in inflation is surpassing the rise in GDP growth. What does that mean? Stagflation, baby. In the UK, in the US, in Germany, in Canada, in Italy, in France, and the only exception here is Japan. And today, Reverend Elon Musk from Tesla, not today, but yesterday, he came out and said inflation's true magnitude is even worse than the federal data shows. Now we have the richest man in the world also joining us and saying the data we're getting from the kitchen, the Bureau of Labor Statistics, is fake. This is cooked data. The true nature of inflation is much, much higher. And when Elon Musk says this, a lot of people would listen. But if the Maverick of Wall Street said this, and by the way, I've been saying this for a long time, nobody gives a shit. So the weighting of Elon Musk saying this is critically important. Musk said, I think the official numbers actually understate the true magnitude of inflation, and inflation appears to be likely to continue for at least the remainder of this year. Musk noted that some suppliers are requesting 20 to 30% cost increases for parts from 2021 to 2022, well above the 8.5% inflation rate reported by the kitchen. Here's the fantasy from Musk, but Musk said he does not think Tesla will raise prices again soon. And I say hold your horses, the prices of Teslas will continue to move significantly higher. On one hand, you have out-of-whack demand, insane demand fueled by the Fed's cocaine operation, flooding the system with liquidity. Some of that cash landed in stimmies, but also in chasing stocks and cryptos, elevating the wealth of the nation. At least artificially so, and the elevation of the nation's wealth was not equal in nature. The majority of that liquidity landed on the lap of the 1%, the very, very rich. But all of this loose liquidity in the system is increasing the purchasing power of certain consumers. A slice of American households who happen to like Tesla and can afford Tesla, and they continue to pay the increased prices. The demand is way out of control, and the problem is the supply is nowhere to be found. So Tesla might say, oh, we're not going to increase prices right now. The reality suggests otherwise. You have to increase prices because you got no other choice. You got to destroy that demand. You're not going to be able to supply all of that demand. And hence, what we talked about in yesterday's video. Now, even barons are talking about the same thing. Tesla's stellar earnings show the challenge Jerome Powell is facing. When they say demand is already weakening and cooling down, Tesla's earnings suggest otherwise. So the company on one hand has to destroy the demand by increasing prices higher. On the other hand, the Federal Reserve has to also destroy that demand by increasing interest rates higher and tightening the monetary policy. So you have a double whammy on the demand in this economy. You think this will be good for the stock market? Think again. You might ask, hey, what is the problem here? Why is the Fed being so aggressive? Why would Tesla have to increase prices? It appears that we're all getting richer. The economy is doing fine. What's the problem here? The problem is, if we don't do anything in controlling this insane demand, we will get to either hyperinflation or stagflation. And in certain areas of the economy, we're already seeing stagflation. And sooner or later, the Fed will be forced to become even more aggressive because inflation doesn't go away on its own. It goes away after destroying everything. And the problem is, if the Fed waits right now for inflation to cool down on its own, A, it's not going to happen. B, they're going to have to be even more aggressive. At that stage, the economy will not have the cushion it has right now to absorb the shock. Right now, we have a low unemployment rate. We have high demand in the economy. To a certain degree, this economy can absorb the shock. The problem is, it will require the Fed to be more aggressive than what the economy can handle. Eliminate this inflation once and for all. Look at U.S. natural gas. The crazy prices with no relief in sight. Everything is moving higher. We have a disaster in this economy, specifically in small businesses. In restaurants, for example, they cannot find the goods to make the meals, and they cannot find workers to hire. It is a slippery slope. Some restaurants are no longer making key menu items and outsourcing everything from onion rings to soup. And the credit card companies are adding a double whammy on those small businesses by increasing fees day after day, week after week. They're exercising their inflationary power. And now we have Congress and merchant groups urging credit card companies to drop the swipe fee increases. At some point, it's not going to make sense anymore for small businesses to operate because, for now, they can continue to increase prices higher to offset all of these increased swiping fees and extra input costs incurred by inflation. But there is a limitation to all of that because at some point, the consumer is not going to be able to keep up with this inflation. And we're already seeing this happening in this economy. So they have to prioritize their spending. And guess who gets hit right off the gate? Small businesses, specifically restaurants. When the experts talk about the cyclical economy and the reopening and watch out for the hotels and the casinos and cruises, the consumer is going to go out spending and splurging. So you got to buy these stocks. Watch out here. Business travel revenue for the U.S. hotel industry is expected to fall some $20.7 billion short the pre-pandemic levels this year. Where is the V-shaped recovery, you might ask? The V-shaped recovery was garbage to begin with. It's a fugazi. It doesn't exist. And look at this. When we talk to the consumers from different income levels, below $50,000, these are the poor. 50,000, 99, those are the middle class. And then 100,000 or more, I assume these are the rich, even though $100,000 a year in California will get you nothing. I say $100,000 in California these days is poverty line. But anyhow, the question asks, which of the following, if any, will you consider doing if higher prices persist? The majority, over 50%, from all income groups agree that they will cut back on dining out. So watch out for all of these restaurants. You see, when the recession happens, the first casualties will be these small businesses, specifically the restaurants. Now remember exactly back in 07, 08, everything was hot, and then by the fourth quarter of 08 and then 09, small restaurants got completely wiped out. The small business ends up paying the price of the misjudgments and reckless policies by the Fed and the banks and the government. A lot of consumers also said they will cut back on driving, cancel a trip or vacation. Watch out for Airbnb and the hotels and the casinos, cruises. Cancel a monthly subscription. And we're already seeing this happening in Netflix, for example. Then you have switching from buying a brand name to a generic product, delaying buying a car, buying a home, etc., etc. When these consumers are also asked, which of the following, if any, have you done in the past 6 months because of higher prices? Listen to this is important. The change in consumer behavior. Over 50% of the middle class and the poor said they cut back on dining out. And then we have a decent percentage from all income groups, cutting back on driving, canceling a monthly subscription, canceling a trip or a vacation, delaying buying a car. But of course, the impact for the higher income groups pales in comparison with the poor and the middle class. And hence, that explains why the demand remains intact for Tesla, for example, a premium product that is catered to the upper class, the high income groups. For the Fed to control inflation, they have to erode the demand in all income groups, not just the poor and the middle class. So more tightening on the way. And here's the last question of the survey. It says, which of the following has caused you the most financial stress over the last 12 months? The majority, including the high income groups, say gas prices, then housing costs. But look at the disparity here. Housing costs impact who? The poor and the middle class the most, because they're not homeowners. They got to pay all of these high mortgage rates, home prices to the roof, rents exploding higher. And then we have food costs, health and Medicare costs, which impacts the higher income groups the most. And then lastly, credit card debt, which, by the way, it's going to become a major problem in the next few months because the consumer, to keep up with this inflation, the consumer has been swiping those credit cards up and down, up and down, up and down. We will see the impact of that in the next few months. So here it is again. Inflation is a major problem. And if inflation continues to stay high, as it is right now, we will see changing consumer behavior, which will crush the economy because we will see a recession right away when the consumer is spending more on gas, groceries, utilities, rents, mortgages, and they're not spending more on services and fueling that economy. We head into stagflation. And then the Fed has to do something about it. When they do something about it, we head into a recession. So the key for now is the Fed got to act immediately while the economy still has some cushion to absorb the shock. The bulk of the increases in interest rates must be front-loaded because the economy can take it right now. But in the fourth quarter of this year, for example, the economy will be severely bruised, and doing a 50, 75 basis points hikes then will guarantee that the economy will head into a recession, if not a depression. And this is exactly what we've been saying in this channel over and over and over again. And now the Fed is confirming all of that. Not because they want to, but because they have to. They're forced to do it. And unfortunately, the collateral damage will be losing a lot of jobs and crashing the stock market, along with the real estate market too. Former New York Fed President Dudley suggested that we have to see more pain in the equities market before we see financial conditions tightening the Fed's taste. Buckle up, he says. The Fed is about to get tough on inflation. Even St. Louis Fed President James Bullard, who a lot of folks are assuming is becoming more dovish, maybe he bought a lot of calls recently, but he also suggested a 75 basis points as a possibility when we talk about the hikes in the Fed funds rate. We also heard from perhaps the last dovish Fed president right now, from Chicago, Charles Evans, who said that interest rates will probably rise above the level that neither restrains nor speeds up the economy. And what is that level, Mr. Evans? Oh, yeah, he cannot answer because he decided to retire. And I say it's a smart move by Evans because I would say next year or so, this economy will be in shambles and the pitchforks will come out. So you better escape now, Evans. Smart move. We also heard from San Francisco Fed Daily, who said, I see an expeditious. Pay attention now. It's not just Bullard who used that word. So did Powell, and now Daly. Expeditious. That's the new transitory. The difference is transitory was positive to the stock market. Expeditiously is bearish. It causes panic, and a lot of diapers have to be changed. Anyhow, she says, I see an expeditious march to neutral by the end of the year as a prudent path. What is neutral, by the way? They say it's 2.5%. Give me a break. 2.5% is not even close. You gotta go to 5. And then we're talking. But here's the thing, folks. Watch how the Fed is gonna screw up again. They're gonna act aggressively right now and get it to 2.5%. And perhaps we will see a reaction by the stock market, by the commodities market, and we see inflation cooling down. But here's the problem. Just like we saw back in the 1970s, the CPI went down, severely so, but it curled its way higher again. Why? Because the source of inflation is still here, the loose monetary policy. And inflation did not go away until Paul Volcker increased those interest rates above the inflation rate, and then inflation went down. So let's say they're going to use this strategy right now of 2.5%, and inflation cools down back to 7.5%, 6.5%. And a reminder, these are the fake numbers, of course. But regardless, we go down to 6.5%. And then inflation is going to pop higher again. What is the Fed's plan if that happens? Nothing. They're going to have to be more aggressive and slam on the brakes even more, which will ensure that this economy will go into a recession, if not a depression. But rest assured, the Fed might have another trick up their sleeves, another radical move, which we will talk about in a second. But let's talk about the comments from Powell before we do that. The headline reads, 0 to neutral in 9 months marks a defining pivot for Fed Powell. Jerome Powell today said that taming inflation is absolutely essential and a 50 basis points hike is on the table for May. Look at him with the stupid look with the glasses. This is my fault? This is my problem? I did this inflation? Yes, you did. Powell said, I would say that 50 basis points will be on the table for the May meeting. Powell also added, we really are committed to using our tools to get 2% inflation back. And I say good luck. But pay attention now. For now, the Fed is playing this game that they will get back to 2%, which is impossible, by the way, considering the fact that they think that the neutral rate is 2.5%, which is a joke. And this is why I say perhaps the Fed has another trick up their sleeves. Hold that thought. Because they say, the experts, they say, oh, the stock market is already pricing in all of these increases in interest rates. Bullshit. Maybe the bond market is, maybe the interest rate futures market is, but not the equities market. The equities market still doesn't get it. Interest rate futures are fully pricing a half-point move in the benchmark lending rate when U.S. central bankers meet May 3rd to the 4th, and another half-a-point hike is fully priced in for June. So for now, we're pricing in 50 basis points hikes for May and June. But it gets even worse. Here it is. Investors are betting on a third half-a-point increase for July, and Powell's St. Louis Fed colleague James Bullard has opened a debate about doing a more aggressive 75 basis point increase if needed. Is the stock market paying attention to all of this? Of course not. It is not even pricing in the 50 basis points in May, and hence the negative reaction that we got today. And I say if you're going to do 75 basis points, do it right off the gate in May, while the economy can absorb the shock. Powell said there is something in the idea of front-end loading moves if appropriate. So that points in the direction of 50 basis points being on the table. And listen to this. Powell declined to comment on market pricing, but did note that minutes of the Fed's March meeting showed that many officials backed one or more half-point rate increases to cool prices. In other words, Powell doesn't want to admit whether market expectations are right or wrong, but most importantly, he doesn't want to admit the fact that the stock market is not pricing in all of these interest rate hikes. The stock market remains sanguine about all of this, wrongly so. Look at the real rates, for example. They're moving positive once again. What happens when the 10-year yield, for example, moves higher? And we're not just talking about the actual one. We're talking about the real 10-year yield. Well, when that happens, stocks become even more expensive. Why? Because the TINA argument becomes weaker and weaker and weaker. There is no alternative, they said when they pumped the equities market higher. Well, we're now seeing an alternative emerging, and hence the Tina argument becomes trash. Valuations become really important. And here it is before we wrap up. Here's the trick that the Fed might pull up if they become really, really desperate. And based on the outlook, they will become really, really desperate. I mean, they're already desperate right now. But at some point when they fail to tackle this inflation, they will resort to this trick. Here's from Mohammed Al-Arian.
Longer term, we're not going to get back to the Fed's 2% this year or next year. So the Fed's going to have a really difficult choice. And it's only a matter of time until you hear people talking about the Fed having to change its target. So, yeah, we do have an inflation issue. We're not going to get anywhere near.
Now you're raising a tough one. Okay, so what would force them to change their target, and what would that target be?
So what will force them to change that target is the recognition that by being so late, they can't get to that target and that credibility is threatened. They will also worry that by hitting the brakes too hard, they may push this economy not just into a short-term recession, but into a longer-term recession. And they will be very tempted, and lots of people will push them to raise that target from 2 to 3 as a way out. Now, that's not going to be an easy way out, and it's going to be incredibly controversial. But that's what you get when you waited too long to recognize what inflation is and to take action. We should have started QT last year. We didn't, and we're now bearing the consequences of the Fed being so late.
So, in a nutshell, when the Fed finally loses the battle against inflation, the trick up their sleeve is, what if we just increase our inflation target from 2% to 3%, maybe to 4%? And hey, why not just 10%? Let's make it 10%. And ta-da, we don't have an inflation problem anymore in the economy. See how smart we are? And of course, the Fed is going to deny all of that. Here's the king of doves, New York Fed Williams. Listen to what he said.
The BlackRock analysts, world's largest asset manager, say that you can't raise rates high enough to bring inflation down to 2% in the short run without an unacceptable level of unemployment. How high are you willing to go on unemployment? They also suggest you may just learn to live with 3% inflation instead of 2%.
Well, I'll start with the last part. I don't agree with that. We have a 2% longer run goal. We've discussed that thoroughly. That is our long run goal, and that's what we're going to stay with. So we're going to get inflation back to 2%. In terms of the unemployment and the risks there, clearly this is a period of great uncertainty. It's a challenging circumstances to conduct monetary policy, bringing inflation down while trying to keep the economy, the labor market strong.
Okay, he sounds desperate. He sounds like he's not sure they're going to win this battle against inflation, which means when he says, yeah, we're not thinking about 3% or moving the inflation target by the Fed, bullshit. At some point, they're going to have to do it because right now their strategy is too mild. It's not going to work to tackle this inflation. And they're going to have to resort to propaganda and manipulation and cooking the data and moving their inflation target altogether. Ladies and gentlemen, the Fed is becoming too desperate, and this is a major, major problem. Let's move on to cover the market information that we got today, and we start with the closing of the indices, and here we go. The Dow Industrial Average was down 368.3 points, or a decline of 1.05%. The Nasdaq down big, 278.41 points, or a decline of 2.07%. The S&P 500 down 65.79 points, or a decline of 1.48%. The day started as a gap higher, and then we got the flush down, the gap and crap, and the flush down did not stop all the way till the end of the day. It was painful from the get-go. The sectors' performances were awful, all in the red, none in the green, no sector deserves a medal today, and the decliners were led by materials, energy, and communication services. The advance to decline ratios, NYSE 16% advancing versus 80% declining. The Nasdaq 19% advancing versus 77% declining. Now, every time we get these overly depressed numbers in the advanced decline ratios, we get a rebound. This could happen in the pre-market. This could happen in the morning right off the gate. The problem is, will any rebound be sustainable now that we have Jerome Powell pretty much putting the 50 basis points right in the bag? We're seeing a lot of slowdowns in earnings. We'll see. Moving on to commodities. Energy was doing good. The WTI gained almost 2% today. The Brent gained almost 1.75% today. Gasoline was up almost 1.5%, although heating oil was down by about 1%, and then we have natural gas pretty much in the flat line. When we talk about softs, we have gains led by coffee. I'm still in coffee, by the way. Coffee was up almost 4% today, followed by lumber with gains of about 3%, and then sugar acting sweet and closing the day with gains of 1.38%. Yet we have decliners, led by OJ down a little over 1.5% again, and then we have cotton down almost 0.75%. On the other hand, cocoa remains on the flat line. Metals, gold on the flat line, averting the damage, but we have damage in silver. Silver is down over 2%, platinum down almost 2%, palladium down 1.75%, while copper, the only bright light in metals futures, closing the day with gains of a little over 0.5 percentage point. Meats, the slaughter of lead hogs continues, down a little over 1.5%, yet we have gains for live and feeder cattle futures. Feeder cattle futures gaining a little over 1.5% today. What about grains? A down day for wheat, corn, oats, soybean meal, yet we have flattish activities for soybeans. On the other hand, we have gains for soybean oil of about 1.35%, and then we have rough rice also scoring gains, be it modestly, and then canola, the winner in grains, scoring gains of about 1.5%. Moving on to the big casino, the options market. What's going on here? We're seeing the volume coming back, but it's coming back in buying puts, unfortunately, for the bulls, of course. But here it is at number 1, Apple. The hottest table by far at around 1.4 million contracts traded today. About 56% of those were calls. Number 2, Tesla, the souffle, with around 1.2 million contracts traded for the name today. About 55% of those were calls. Number 3, Facebook, Meta, with around 450,000 contracts traded for the name today. About 46.5% of those were calls. Here are the unusual activities that took place in the options market today. We start with the ticker FCX, Freeport McMoran. And ooh, what a beating it got today right after earnings, down almost 10%. Not good considering that I own the name, but somebody's bidding for more pain to come. The good news is I'm hedged. I already have puts, but somebody here is bidding for more declines to come. Big ones. They bought the 36 puts for the expiration date, July 15th, with expectations that the name could move down by more than 20% by then. They paid around $1 a piece to enter this trade, all in all spending around $4.3 million. What about the ticker XOP for the oil ETF? They're betting for more downside to come by buying the 128 puts for the expiration date, May 20th, with expectations that the name could go down by more than 8% by then. They paid around $3.25 a piece to enter this trade, all in all spending around $7 million. What about the ticker EQT? An oil and gas, but specifically gas producer. So this is really interesting. They're betting against the XOP, but for natural gas EQT. In this case, they bought the 49 calls for the expiration date, June 17th, with the expectations that the name could move higher by more than 16.5% by then. They paid around $2 a piece to enter this trade, all in all spending around $2 million. What about the ticker NUE for Nucor? They're buying puts this time around, the 160 puts for the expiration date, June 17th, with expectations that the name could go down by more than 9% by then. They paid around $6 a piece to enter this trade, all in all spending around $4.2 million. What about the ticker CION, Coinbase? They're buying puts, betting for more downside to come, in this case the 120 puts for the expiration date, May 13th, with the expectations that Coinbase could go down by more than 12.5% by then. They paid around $5.50 a piece to enter this trade, all in all spending around $2.5 million. Continuing with interesting trades, what about the ticker PYPL, PayPal? They're buying calls. The name is severely beaten, by the way. They're buying the 95 calls for the expiration date, June 17th, with expectations that the name could move higher by more than 6% by then. They paid around $6.50 a piece to enter this trade, all in all spending around $2.5 million. What about the ticker CHK, Chesapeake Energy? Notice the theme here. They're buying calls on EQT, they're buying calls on CHK, but they're betting against oil. So will oil go down and nat gas move higher, perhaps? In this case, they're buying the 100 calls for the expiration date, July 15th, with the expectations the name could move higher by more than 10% by then. They paid around $4.50 a piece to enter This trade, all in all, spending around $1.6 million. Lastly, what about the trade for the ticker SPY for the S&P 500? They're buying puts, in this case, the 412 puts for the expiration date, July 15th, with the expectations the SPY could go down by more than 6% by then. They paid around $10 a piece to enter this trade, all in all, spending around $3 million. Moving on to the heat map analysis. What's going on here? A sea of red, a bloodbath across the board with very, very few exceptions. We're talking about IBM, we're talking about AT&T and Verizon, we're talking about AbbVie, we're talking about certain earnings names like Tesla, the ticker ABB, CSX, and the airlines, of course, on the heels of United Airlines earnings. And then we have tobacco. Philip Morris also reported earnings, but that's about it. The rest of the market is down big across the board, indiscriminately, by the way, and pain, a lot of pain. We're talking about stocks down double digits in a single day. We'll talk about them in a minute, but let's talk about certain corporate news. We start with Amazon, the ticker AMZN. It was down big today. And of course, we're getting the news that the Amazon workers who did the Easter shift got rewarded by the company by a raffle. For what? $1 million? A car? A set of steak knives? Of course not. For a bag of chips and water. How humiliating can this be? Unbelievable. And you wonder why all of these unions are popping up. And then we have, speaking of unions, we have Apple, a Brazilian judge. This is a good one, by the way, because the judge ruled that the U.S. tech giant Apple engaged in an abusive and illegal practice by selling new phones without power adapters. And of course, you're not going to see a U.S. judge issuing any of this because they're all in the pockets of Apple. They're all shareholders of Apple. And then we got news from Facebook, Meta, the ticker FB, down big today again. And this should be a bombshell, by the way, because you got Sheryl Sandberg, who used Facebook resources to help the embattled CEO of Activision Blizzard. Why? Because he is her little ex-boyfriend, and she wanted to help him out, using the company's resources. How is this not a bombshell story? How is this not a big scandal in the business news channels? I think you know the answer. And then when we zoom into the cyclicals, for example, look at Carvana, the ticker CVNA, down big from the highs. We're talking over 60%, but it's down big again today by almost 10%. And of course, Bloomberg says the father-son team behind Carvana is losing wealth fast. The Garcias they're talking about. By the way, a convicted criminal, the founder of Carvana. But rest assured, you don't have to feel bad for them because last year, the CEO and his dad dumped billions and billions of dollars worth of Carvana stock, right at the top, by the way. So feel bad for the shareholders who are down 50, 60, 70%. This is a racket, folks. If you're not careful, you're gonna be the bag holder. The executives, the CEOs, the insiders, the 1%, they always win, because even if they lose, the taxpayer have to bail them out. We also have steep losses in materials, be it gold miners, be it copper, FCX down big, be it the fertilizer names, Nutrien, Mosaic down almost 9%, Alcoa, aluminum down big, over 16%. So we're seeing a massive unwinding here in the commodities trade. Of course, you combine the earnings with the Powell panic, and you get these results. But what didn't the market like about Alcoa's earnings? We talked about it in yesterday's video, but here it is. The argument is the net income of the company improved dramatically, not because the demand is high, not because the volume is high. They're selling more. Look at the volume. The volume is actually down. But the net earnings were pristine because the pricing power. So they're not selling more. There is no demand. This is the argument. But for whatever demand left, Alcoa is practicing their inflationary pricing power. And that's all there is. And the market did not like that. But it is the same story, by the way, with Tesla, for example. Why do you think Tesla's earnings are to the moon? It's because the price gouging, the pricing power. The volumes are going to go down across the board. The question is, does the company have the pricing power to withstand the storm or not? We're going to talk about the chart of Alcoa in the charts analysis, by the way. But here's another earnings mover. The ticker BX Blackstone was down over 6% today. For all of you who've been holding puts, congratulations. That one is a steak and lobster kind of trade. Let's move on to the heat map for the ETFs. A bloodbath across the board. Everything is down. We're talking about literally everything. Growth, value, energy, technology, materials, small caps, big caps, didn't matter. International markets all down. The commodities, uranium down big, gold down big, Silver down big, but natural gas UNG is rebounding a little higher. Besides that, there is nothing to see here. So let's move on to charts, and we start with the SPY, the S&P 500 30 minutes chart. It made it above 446.5 in the morning in a gap up, but look at that crap. I mean, you can barely see any green candle here. It was a flush down with no mercy at all. Did not respect any support lines, maybe a little bit at 443, which was an important support line, and then right at the bell at around 438. This is a reversal because we no longer have higher lows. Soon enough, we're going to go back under the sloping line of resistance. The next support will be 434. This is a bad development. At some point, we might get an oversold bounce, but that bounce will be an opportunity to dump again until and unless we get good earnings out of the big guys: Apple, Amazon, Google, Facebook, Microsoft. If these guys bomb, then goodbye. It's over. And here's the daily chart for the continuous contract for the SPY, the S&P 500. A massive rejection candle, a failure to rally above 4,472. The good news for the bulls for now, keyword for now, is the fact that they're keeping 4,384.5. The volume is moving higher on a down day. The momentum indicators are moving down again. The bears are turning the tide fast against the bulls. And the moment the bulls lose 4,384.5, we will see another flush down all the way down to 4,232. The bears are fighting back. They ambushed the bulls out of nowhere. And this is a massive reversal. And it gets even worse for the bulls. Look at the SPX, for example, the cash index. It got rejected exactly from the 200 days moving average. We've been waiting and waiting for a climb above the 200 days moving average. But we now have a rejection. This chart is not ready to trade above the 200 days moving average. So the inevitable conclusion is we're going down to 4,000. Unless there is a rescue operation, that operation better come by tomorrow. Otherwise, it's going to get really ugly. Here's the Q's 30 minutes chart for the NASDAQ. A gap and crap once again. The gap got us all the way to 347, which was the resistance over and over again. And we finally got the last rejection today. It got us all the way down to 343, spent a little time there. That support did not work out. We've been talking about the weakness of that support even after the fundamental left off by Bullard, which was negated, by the way, by Jerome Powell today. And then 341 did not even hold. The chart went down all the way to 334, which is the last important support. The bulls better rebound from this point on, or it's going to get really ugly. How ugly, you might ask? Let's move on to the daily chart for the continuous contract. The bulls lost 14,000 for good for now, which is a bad development. The volume is moving higher. On a down day, another bad development for the bulls. The bears are attacking big time, moving these momentum indicators to the downside. And soon enough, if this continues, we will go down to 13,599. But in all likelihood right now, we will go down to the most important trend line in yellow, which will coincide with 13,300. And if that is lost, then we could see a crash. Yep, a crash. Here's the IWM, the Russell 2000 30 minutes chart. We got the pop. It got us all the way to 204.5. Didn't make it over there. Got rejected big time. It lost 201.68. Didn't even look at it. And we're now looking down to 196.5. Perhaps we could have gotten there if we had more time, but the bell saved the bulls. Could we get oversold at some point? Yes. Are we oversold? Not quite. We need another whack in the head, maybe a gap down tomorrow in the IWM, SPY, Qs, and then we could get a rebound, an oversold rebound that you and I can trade. Now we'll talk about ideas by the end of this video. Here's the Dixie and hourly chart. Look at that bounce. Exactly, pretty much to the penny of my number, 99.89. So what now? The negative divergence is still here, meaning that the dollar could go down. And this will be good for commodities, good for gold, good for stocks, by the way. The only relief in sight for the equities market right now is if the dollar flushes down. Yet the resiliency of the US dollar remains stunning. And the reason is, it is supported by the Fed's aggressive hawkish policy for now, which is not so aggressive really. They need to be more and more aggressive. And that kind of explains it, by the way. The dollar is only strong because other currencies are weak. The dollar should be trash right now, in the garbage, after all of this printing. But the weakness of other currencies, because you have other banks who also printed like crazy. So the US dollar is only strong, relatively speaking. Here is gold. What do we see in gold? Is this the beginning of formation of a bear flag, perhaps? But we also look at the MACD indicator, and we have a battle between the bulls and the bears. It's not over yet. The bulls could move gold back into positive momentum once again. again. So it's not over until 1,925 is lost as support. What about oil? What's going on here? In Brent, we're talking about a 4 hours chart. This is a bearish consolidation. The chart better move higher immediately, but we're not going to buy anything here. We're not going to buy, we're not going to sell, we're not going to do anything. Short, nothing. Why? Because you got to wait for two things to happen. To short, you got to see the support of 105.84 lost. Now, if you want to go long in oil, you got to wait for 114, the last resistance, to be broken, and then we go all the way to 118 and take it from there. But for now, there is nothing you can do. There's no trade here. What about the 10-year yield? What's going on here? I'm being careful not to call a top in this chart because every time we attempt to call a top, we get smacked in the mouth right away, and this chart moves higher and higher and higher. And I continue to say, folks, for all of you who bought the TLT, the dip in the TLT via calls or otherwise, the technical rebound is not as strong or sustainable as the fundamental rebound. We need fundamental news that creates the top in the bond market, in the 10-year yield, I should say, and then the bottom in the TLT. For now, we have nothing in the fundamentals that says the 10-year yield should go down. Here's the TLT, a weekly chart. Lost some of the gains from yesterday, but the hope is still alive. We got one more day to close here. And all in all, it is oversold, technically speaking, but we gotta wait for the fundamentals. There are no fundamental news driving this rebound at all. So the sustainability remains in question. What about the VIX, a 4 hours chart? We have a massive pop of 20. The RSI remains in negative divergence. This is a 4 hours chart, by the way. Yet the MACD indicator is showing green impressions on the histogram. This is the beginning, though. We have to wait for a confirmation. The good news for the bears, we're talking about the SPY bears, the S&P 500 bears, is the fact that we have a massive rebound of 20. In all likelihood, the bears will be able to close the VIX above 20 for the week. And here's the VXN, another rebound higher of 27.5. The MACD indicator is accelerating again. This is not a good sign for the NASDAQ bulls. And the good news for NASDAQ bears is there is a high degree of possibility this chart will close the week above 27.5. Here's Apple, a daily chart, another rejection from the upper edge of the channel. This is not the first rejection, by the way. What does that tell us? It tells us that the chart doesn't have the energy to climb above that number. It doesn't have the energy or the momentum to go above 172.4. We're seeing selling on higher than average volume. We're seeing the momentum indicators still in negative divergences. What about Tesla, the souffle, an hourly chart? What's going on here? A massive pop higher off the gate, gap higher, and it stopped exactly at 1,090.5, which was the resistance we identified after 1,025. It got down to 1,025 and it got rejected again. It did not make it. So the chart went down to retest 995 as support, and the jury is still out there whether 995 is support or not, because we ran out of time. For all you know, Tesla could go down to close the gap. When we zoom in to a 5 minutes chart, for example, you had two opportunities to short right off the gate. Number one, the rejection at around 1,090.5. Now I'm highlighting the rejection and the confirmation candle right after that. That was opportunity number one to short. Opportunity number two came when the chart broke below 1,025. It went higher to retest and reclimb 1,025 as support. It did not make it, and it got another rejection, and that was right there and then the opportunity number two to short. Now we have bad news for Tesla, by the way, because even though the earnings were good on face value, the question is the sustainability of keeping these margins, the sustainability of continuing to increase prices higher without hurting the demand. On top of that, Elon Musk is involved in this battle with Twitter, and it's gonna get really ugly. But before that gets ugly, of course, the con man of the century is securing his own pockets. All of this pumping of Tesla got him another compensation package worth $23 billion. So Elon is going to be fine even after Tesla stock crashes. But will the shareholders, the mom and pops, the retail investors chasing the mania be fine? I doubt it. Elon is now says he secured $46.5 billion in funding to take over Twitter. But here's the problem. More than 2/3 of that is coming either from his own pocket or borrowing against Tesla shares. This could be a disastrous outcome for Tesla. Don't do it. It's not worth it. But of course, Elon is going to do whatever he wants to do. Here's Tulips, Bitcoin. What's going on? We got a rejection of 42,000. Did not make it. But it's not a definitive rejection yet. That will happen when we lose 40,000 for good. AMC losing a lot of momentum. Look at the MACD indicator, for example, crossing, creating red impressions on the histogram, which means if the apes don't show up and start buying calls immediately, I'm buying the shares, by the way, we don't have any support support here. The chart is going to go down to 14.24. Here are some bonus charts for you, specifically the names that you guys have been asking me a lot about. Let's talk about Alcoa, the ticker AA. This is a weekly chart, by the way, and look at the momentum indicators, the RSI, and the MACD indicator. The RSI is in negative divergence. The MACD is already crossing, showing red impressions on the histogram, meaning you don't want to have the FOMO and buy the dip right away. Give it a little time. We have support number 1 at around 70. If that doesn't work out, then we have the trend line in yellow, which will be around 60 at that time, so we could see more pain to come here in Alcoa. But for now, it remains, fundamentally speaking, a company that is beating inflation. And if everything is going to go down, I'd rather be with the companies that are still enjoying the pricing power. It's not going to last forever. If the Fed wants to really smash the economy by increasing interest rates dramatically, commodities and these names will also get hit too. Everything will get hit too. And the last trade will be tobacco, alcohol, and McDonald's. What about a weekly chart for the ticker BX Blackstone? I'm short the name. We have lower highs, we have a sloping line of resistance, and the chart could not make it above that line. We have negative divergences in both the MACD and the RSI indicator, and we have the support at around 108.5. If that support is lost, we will see a flush down, a big one. And this happened, by the way, with many other charts with the same formation. What about the ticker MOS, Mosaic? This is a weekly chart. We have a massive pullback. We have a negative divergence on the RSI. The MACD indicator is highly extended. It needs to pull down. Give it a little time, folks. You don't have to buy the first dip when it happens right away. You could be catching a falling knife, specifically if natural gas prices don't rebound. For example, when we use the Fibonacci support, we could go down another 9.5% before the chart finds support and before the excess in the MACD and the RSI is washed out. What about the ticker ZIM? It's a shipping company. I'm long the name, but since dividend paying day, it has been a flush down with no mercy at all. We're now flirting with the trend line. If that is lost, it's going to be a disaster for the name, but look at the momentum indicators. They're already bottoming. A lot of excess have been washed out of this name. It is a value name. It is a high dividend paying name. Waiting and waiting and waiting for the rebound. You don't have to jump the gun and buy right away. Wait for two things to happen. Number 1, a solid rebound of the trend line. Number 2, a confirmation from the MACD indicator on the weekly chart showing green impressions on the histogram. Here's another one, the ticker FAST. For Fastenal, believe it or not, the name was trading higher amidst the wreckage in the stock market. We talked about this name as an inflation hedge about a month or so ago. The name reclimbed the trend line. It is retesting the trend line for support, and if this retest is met with success, then we will see a rebound and a continuation of the bullish trend in this name. So keep your eyes on the ticker FAST. And lastly, this is a 3-hour chart for the ticker SHOP, Shopify. The name is down big year to date, over 60%. And it is down big again today. It's down big for the week. It has been painful for Shopify's shareholders. But when we look at the 3-hour chart, every time the RSI got to these levels, these depressed levels, we got a double digits rebound in the name. So my hunch is, if we have another down day tomorrow, for example, right off the gate, a gap down, let's say, I will be buying calls on Shopify, betting for a rebound rally. I'm not buying the name for good. It's trash. I'm just betting for a rebound. It is getting really oversold. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the flash PMI. It will definitely have an impact on the stock market because it impacts inflation outlook. And then on the earnings calendar, we have American Express, Verizon, Kimberly-Clark, Newmont Gold, and Cleveland Cliffs. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And most importantly, expect the unexpected. I will talk to you again tomorrow.